Dear friends, thank you for supporting this channel on Patreon to join our growing family of donors, now 59 patrons strong. And remember, once we reach 100 active patrons, we will start sending out a 1-ounce U.S. Silver Eagle, autographed by your host, Dunnigan Kaiser, to one active supporter each and every month. Thanks for taking a minute to pitch in by going to patreon.com/reluctantpreppers and pledging your support today. Thanks very much.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're delighted to have this returning guest. Lynette Zang is the Chief Market Analyst at ITM Trading. She's here with us again on Reluctant Preppers. Lynette, thank you for joining us once again.
Oh, and you know, it is my pleasure to be here, Dunnigan. Thank you for having me back.
It's a bit formidable times that we're in, because we had you several times in the fourth quarter when it seemed the markets were in unstoppable melt-up mode. And since they stumbled big time in early January, and then even bigger again in February, and you've been revealing to us some of the interbank lending, drying up of the trust between major banks, and others have been running around scrambling, trying to tell us what's going on with what are the driving factors behind the sea change in the markets. And we thought we'd first give you a chance to weigh in on that. And we promise our viewers that if they stick around till the end, we'll be talking about your backyard gardening and specifically your floating islands that you just added on your
fabulous
to your swimming pool. So first off, let's start with the markets. What in the world do you see as the major driving factors that are causing this huge sell-off? We had like a 400-point sell-off today in the Dow. We are recording this, by the way, folks, on Tuesday, May 29th, 2018. Go ahead, Lynette.
Yes. Well, there's, we hear a lot of talk about the strong dollar, okay? And what they're talking about is the dollar in relation to other fiat currencies. So when the dollar gets stronger, it's all about debt. I mean, that's really what the bottom line is. This whole thing is about debt. But when our currency is weaker against other currencies, they took out a lot of debt in the emerging markets. So that would be places like China and Russia, South Africa, Indonesia, India. There's a number of emerging markets, right? But as the dollar has strengthened against their currency, it now takes a whole lot more. And they don't earn dollars. They earn rupees or rubles or whatever it is that they earn, but they do not earn dollars. Yet they have to pay all of this debt in dollars because they've denominated it in dollars. So what's happening really, and this is true, well, in Italy, they're saying geopolitical, but the debt levels are so enormous that the system seems to be, I'm not really fully prepared to say that it's a full implosion, but they can't get liftoff, not with all the new tax money, the earnings growth because of that the tax cuts, and all of that repatriated money that's flooding back to our shores that should have kept the melt-up markets going. That's what that was all about. But I think that the level of debt is so ginormous that it's now dwarfing their ability to keep it floating. And that has me really nervous, to be really, frank about it, because that's the biggest market that there is. That could very well be ushering in the, not just a tide change, but ushering in the next phase of hyperinflation. And
you mentioned that's the biggest market there. You're referring to the debt market.
Yes, exactly. I'm referring to the debt market. And it's the most important market that there is, simply because that's how money's created, right? So you can be way over leveraged, and yet I think I was reading about this in Malaysia. They're having major problems in Malaysia because of all of their debt. But it's possible that somebody else will loan them money. So somehow, if they take on more debt, that's a good thing. I mean, think about that. That does not make any sense.
Yeah, this
But
whole the whole debt paradigm as far as creating a misappropriation of capital. When we were visiting Malaysia, we visited a restaurant, and it was really quite frightening because the entire neighborhood that this was in, if you could call it a neighborhood, looked like what was left after a war zone or something. And yet
oh wow,
there was like a burnt out carcass of a bus and a car that had been stripped down, and cement buildings that had like the scorch marks on them and everything around there. And then right in the middle of it all was this beautiful pink marble restaurant. Right in the middle of like what looked like it would have been like a concrete strip mall, but it was just the one thing. And even the tile on the sidewalk in front of that was all nice, and then everything else was just destroyed. And we asked our host, who was taking us there, I said, this is very strange. I've never seen anything like this. Usually you see nice businesses in nice neighborhoods or whatever. And he said, well, he says, you don't understand. In Malaysia, when the government changes over, there's lots of corruption and deals that are making it. And usually then a bunch of handouts happen to people's extended family, relatives, friends, acquaintances, that sort of thing, as payback for helping get them in office. And so there'll be huge misappropriation of funds, and there'll be this, evidently they put out a whole bunch of funds to build this whole shopping district or whatever, but then it really wasn't sustained by actual organic demand. It was just somebody was just doing it because it was a favor to pay back to their friends. And as soon as then the government changed over, then all the gravy train dried up, and the thing just collapsed. Except for I don't know how the one restaurant in the middle must have still had an in somehow with the new government or whatever. But and that's a little bit of a diversion. But you mentioned Malaysia, and I just had witnessed.
How long ago were you there?
That was several years back. But just to point out that where you can get this misallocation of debt-based capital into things for reasons other than healthy, sustainable economic growth and real demand.
Well, frankly, I think that we've seen that a lot all over the world. I mean, China's got all those ghost cities, right? So it's about that GDP growth, whether they get it through inflation, because a lot of the GDP growth is about inflation. If I have to pay, $100 for this mug, which I don't, but if I had to pay $100 for this mug, it would make the GDP look so much better. And then that debt to GDP, I mean, it's a whole bunch of smoke and mirrors. But the real risk, and particularly with the debt, is what's happening with the IBORs or LIBOR. IBORs are interbank, because you brought that up, and it's key. It's key. Interbank offer rate. So the rate that a bank would charge another bank to borrow funds overnight. And a lot of contracts, the LIBOR particularly, is the London interbank offer rate.
Right.
So that just happens to be the most popular one. And according to the data, $370 trillion worth of contracts were written against the LIBOR. But the LIBOR, you might remember the scandal. It started it became discovered in 2009. But during the crisis, as we've talked before, and we've seen that LIBOR I showed you just drop off a cliff. And I'll send you that chart, Meg. Make sure you write that down. But it dropped off the cliff. It was way bigger than I frankly understood, because that was the market against which 370 trillion contracts were written. 300 trillion of them notional, which means nobody really knows how much, are derivative contracts, interest rate derivative contracts. And so that happened in 2009. It was discovered. Happened in 2008, was discovered in 2009, but it was leaked to the public in 2012. Because where that was a market rate, okay, I'm a bank, I'm loaning you another bank money overnight. Okay, that's a market. This is what you're willing to pay.
All right.
This is what I'm charging you, right? In 2008, when the banks lost confidence in each other, that market died. And all of a sudden you had all of these contracts and no market to gauge these rates against. So what happened was that there are 18 banks that call up every day and say, okay, this is what we would charge, or this is what we're willing to pay, right, based on a market. Now it was just a random opinion. Now look, if you ask me my opinion and I don't have to back it up, I can tell you anything I want, can't I? Right? So now you had all of these trading desks that said, oh, I can make money off of this trade, and they call their buddy at another bank, and their buddy and I'm not exaggerating on this, for a sandwich, for a lunch, would modify what they would call in as the LIBOR. So it became just a stated rate. Now, that went from 2009 until 2012 when it was leaked that this was just a stated rate. I mean, there are trillions of dollars worth of contracts against this that they're playing for sandwiches. I mean, I'm not kidding. And so then we all knew that, because who had faith in the LIBOR anymore, right? Because they knew that it was just all bogus. It's just a random opinion. You can give any opinion you want. And so we knew that the LIBOR had to die. Then it got real quiet. You didn't hear anything about the LIBOR. There was a little article, because when I see something, I always grab it, even if I'm not ready to use it. But there was an article that came out in June of 2017 saying that these banks had gotten together and agreed on whatever the change was going to be. Okay. And then a month later, you had, it's the British Financial Authority, but it's tied to the Bank of England, the Britain's central bank, coming out and saying that by the end of 2021, they would no longer require these banks to call up and give a random opinion of what the interest rate should be if they were going to pay it or if they were going to charge it.
All right.
Now, it was after the last time I was on and we showed you how the LIBOR had fallen off a cliff and then they stopped reporting on it.
Right.
It was shortly after that when all of a sudden I start hearing all of this on CNBC, because that's what when I'm getting ready in the morning, that's what I listen to. And they start talking about the LIBOR, not in a negative way, but gee, why is the LIBOR going up? LIBOR this, LIBOR that, every day for like 3 weeks. And I said to myself, something must be going on with it. You know, I mean, you're in dead silence pretty much. And then all of a sudden they're talking about it every day. Why? There's a reason. So I dug into it a little bit more. And number one, what I found out was that the Bank of England has now published an alternative benchmark. There are our Federal Reserve has also, well, they haven't published it quite yet, but they're very close to publishing an alternative benchmark to LIBOR. And then there are 3 more central banks that are working on publishing an alternative benchmark to LIBOR. So that's what's happening. They're making this shift because any contract that matures after 2021 must be modified. That's what they call it. So I dug into that to look into this much more deeply. And I could be off on this. I don't have the data right in front of me. But I believe that 68% of that 370 trillion will all need to be modified or really reset. And the problem, there are a few problems with them doing this, okay? Well, number one, they're just now starting to come out with alternative benchmarks. So all of the contracts that have been written since the crisis are still written against a bogus benchmark.
Okay.
Okay? So they don't really have the alternative yet. They have to now create a market for this new benchmark. I mean, we're talking, what, 2.5 years? They've got to create a whole robust market for this benchmark. Okay, let's say that they get that accomplished. I mean, it's a possibility, okay? Well, all of the contracts that have been written, and to date pretty much have been written based upon this benchmark, are calculated in a certain way. Whatever new benchmark that they come up with is going to be calculated differently.
Right.
which means that for banks that, sell a mortgage or put out a loan or whatever they do, or the derivative contracts, certainly, okay, they have a certain level of valuation on the bank's books. All of a sudden, that if they do it perfectly, that valuation is going to change. Well, we already know that Deutsche Bank, for example, is already insolvent.
Mm-hmm.
In a one-way up market, they managed to lose 7% in their assets.
Mm-hmm.
Okay, their leverage ratio is 3.8%. So that means that admittedly, they are a dead bank walking. That's according to their own financial statement, not me. That's their financial statement. And the problem is that everybody is incestuously interconnected. So they have to keep them walking, just like they had to keep Monte de Pesci in Italy walking, which is, another thing that is now appearing to erupt, all of these debt markets. So that's the real trouble that we're dealing with. This market, and according to the ISDA, which is the self-regulatory body for all of these derivative contracts,
all right,
they published, and I can send you this too, Megan, make sure, the one sheet that they did on, all of the different contracts that now have to be amended or changed. Well, for you and me, the retail public, not a problem. As they state, that language is already in the contract, so they're not going to have any trouble amending or modifying those contracts without yours or my permission, because we already agreed when we signed the documents. Okay.
We noticed that when we signed our recent home mortgage, and this was several years back, but that there was some of the later pages you're signing is saying that if they need to amend them, you will accept what they amend. And it's like, wait a minute, how about if that's completely non-parallel, that we can't say the same towards them, but that's the paperwork you have to sign if you want to take out a debt. That's right.
If you want the mortgage, you're going to sign it. Nobody really reads it. I'm impressed that you
we made a nuisance of ourselves. They really weren't going to invite us back. Yeah, go ahead.
But a whole bunch of the different derivative contracts, if it's bilateral or trilateral, so between 2 or 3 entities, okay, they can probably negotiate a modification. But a lot of these derivative contracts have been sliced and diced and commingled and mushed together. And in a whole bunch of cases, I'll send you the documents so you can see for yourself, they need 100% agreement, 100%. Now, if this contract is in your favor, are you going to be real apt to agree to modify it to where it's no longer in your favor?
Not likely.
Nope. So the two big hurdles that they see, part of it is just the sheer volume of it. Because keep in mind that as soon as you hear nominal or notional, you have no idea how much you're really dealing with here. So, nobody really knows, but we know that it's at least 370 trillion. Okay. So, I think that a lot of what we're dealing with here in the debt market, because a massive cratering of the debt market, yeah, okay, that would modify all contracts, wouldn't it? And you wouldn't even know it. You wouldn't even be aware of it. This is why the system has to reset, because there are too many things that are at the end of their cycle. And we're right now, not only have we been existing on pure central bank experimentation, which we absolutely have since 2008. The system died. I can prove it. I didn't even realize how, even though I've talked about interbank, honestly, I didn't even realize that too was showing me that the system 100% died in 2008. And we're just accepting all of these experiments until the reset. And then it's going to be really painful. That's why you really need, gold, silver, physical, in your possession, food, water, energy, security, and community. That's why this is so important. We're going to need each other to get through this. It's not going to be pretty or easy.
When you start describing the complexity and the kind of the almost unfathomable dimensions and size, the scope and scale of that. And then you talk about this timeline that's marching forward, this 4-year, they cast a 4-year net forward, and we're a year and a half into that, and there's only 2.5 years left, and they've not only got to invent a whole new measuring stick and metric, but get 100% of the parties of these complex contracts to agree to it. It really does. What I was building up to here was it explains why a lot of folks who are, for example, subscribers to our channel, their gut tells them, run away, do not, that this is not going to end well, that this is not something that is going to take care of their needs and not something that they'll be able to really understand or influence.
Exactly.
But it definitely could have fallout on their lives, and they want to be able to protect themselves. You mentioned in passing Italy, and I wonder if you could zoom in a little bit on that. Over the weekend, there was quite a bit of press that came out about the failure of Italy to form a new government. It sounded like there were two opposition parties that had maybe not completely been forthright about what some of their intentions were, but when they got together, they suddenly announced, "Hey, we're going to try to leave the Eurozone." And,
exactly.
And then the functionary who was in charge to try to bless whatever was going to be the successor government said, "I can't do that because you guys didn't disclose that, so it wasn't informed consent on the part of the voters or whatever." What's your real view about what's going on in Italy? And some people have said, how significant is Italy really from an economic standpoint? And in the pre-discussion, you and I were talking about how impactful Italy could really be, how it could be really a stone pulling out at the bottom of the dam. So could you talk to us a little bit about the Italy situation?
Yeah, and I'm going to back up to move forward because, honestly, historically, a lot of times different countries have attempted to peg their economies together. It never, ever, ever works. So what we're seeing is the end of the Euro experiment where they were trying to mush all of these different economies into one. The advantage and why a lot of these economies and these countries went along with it, like Greece and Italy and Portugal and Spain and even, France, Ireland was part of the crisis. I'm not sure they're part of the EU. But Germany, Austria, all of these countries is because they could then take on debt at the level of the German economy. But anybody knows that Greece's economy is not the same as the German economy. Right. Italy's economy is not the same. So all that really happened was a lot of wealth transferred to Germany. I mean, it makes sense for Germany allowing the other countries to take on debt to buy their products. Germany is the exporter to the Eurozone. Well, that means that you have a whole bunch of dead banks walking. And Italy in particular has had a massive problem in their banking sector being insolvent.
Yes.
And, they're discovering that this peg is breaking down. I mean, it did with the Brexit, although I won't say that Great Britain was as fully integrated, certainly, as Italy is. They retained their own currency. And so, even so, they voted to exit the Eurozone. And it's still not happened. That was a few years ago. Now, Italy is threatening to make that happen. That means that currency, that block, it just doesn't really, frankly, work, does it? And so, but Italy is also I believe it's like the third or the fourth largest bond market in the world. And again, I go back to this. It's not that's them and this is us. Everybody through globally systemic interconnected banks, we're all attached to each other no matter where we are in the world.
That's something I think that many people don't fully realize. We have this, I don't know what you call this idyllic idea since we were children that our neighborhood bank down the block is its own stands on its own turf there, and other things can come crashing down around us, but that won't affect that. But even the very largest U.S. banks, these quote unquote too big to fail banks, are deeply and incestuously interconnected right at the derivative level and other levels with all these other banks.
Yes, because back when when I was growing up in the 60s and the 70s, and you went to your local bank and you made a deposit, and then the bank, the way that they made money was pretty simple. They loaned that money out, and the difference between what they could charge for that loan and what they paid you to loan that money to them was their profit. But that has shifted, and that's not where banks make most of their profits. In fact, since 2008, the Federal Reserve, for the first time ever, have actually been paying banks not to loan.
Right.
And when they talk about raising the rates, which, they're on a path to raise the rates, it's not on the rates that they charge. It's actually on the rates that they pay the banks not to loan. I mean, you've got to, so this is, and the term is a global universal bank. So those too big to fail, that's their title. So just think about those words. Global, I mean, Deutsche Bank is the most dangerous bank on the planet, and they are a global, so they're all over the place. Universal, their tentacles, they touch every single financial product on some level. Even the itty bitty ones. I'll send you that, the interconnected graph,
okay,
so your viewers can really take a look at that, because it isn't just to the bigger banks that they're attached, but underneath there's this whole spider web. So even your local credit union or local community bank, everybody is going to be impacted when they finally implode. And they are a dead bank walking, 100%. And they are connected with Monte dei Paschi, the oldest bank in the world in Italy, that has been insolvent and been a huge problem for years. I reported on it, maybe, I'm going to go back and look, maybe 2 or 3 years ago. So that's really the problem. It is not them or us, and it's not even the too big to fail. It's the global, universal, interconnected. That's why we've seen the synchronized recovery, right? It's the central banks working together.
Mm-hmm.
Think about what they were doing during the crisis, which was they injected, the U.S., the Federal Reserve, injected massive amounts of dollars into foreign central banks just to keep everything going.
We were
Remember
told.
that?
We were told 400 billion, I believe it was. We were told initially needed to be provided immediately by Congress to help the major big flagship name U.S. banks, and then it came out, well, maybe not 400 billion, maybe it's 800 billion. What we weren't being told about was the 16 trillion that was going out the back door to keep other banks afloat. And that's one of the things I wanted to ask you about. Is a lot of people have talked about this sort of the succession of a scale between financial crises. They were saying, well, first it was going to be, there was this banking crisis, and it was at the regional level or the individual bank level, and then there was this banking crisis.
Like the savings and loan crisis.
Yes, exactly. And then it was that little portion of not little, but that portion of the banking industry, and then it was what was nearly averted with the 2008 collapse. And then they're saying, but the next time it'll be at the sovereign level, and then who will be there to bail us out? And so many people say, well, there's nobody left when you have sovereign economies collapsing or whatever. But what people have often said is, that's right. There you go. And then you might get back to your global universal solution, and that's what many people are concerned about on our channel, is that it takes the control of your individual family's finances farther and farther and farther out of your hands and out of your control. And that's where Gregory Mannarino, and I know you're a fan of his, says become your own central bank and return things back into your own control. If we could...
That's, honestly, the only shot that we really have, because this is way, way, way too big. And understand that, once in 71, when Nixon handed over full control of inflation and the monetary system to the private for-profit banks that are really about they're really about protecting the banks, not the individuals.
Yeah, right.
I mean, ever since then, they've had to create more and more complex products just to keep their engine going, right? So, yeah, I mean, we have to be as independent, and Greg is absolutely right. You've got to become your own central bank. And what are central banks doing? They're buying gold, not in this country and not in Canada, but almost everywhere else, in China and Russia.
If you mentioned earlier emerging markets, can you take us on a brief tour of what's different about what's going on in emerging markets than in some of these major Western economies?
Well, the emerging markets are more dependent on capital inflows and outflows. So I'll send you this chart too, because I'm going to talk about it tomorrow, so that's okay. But what you're going to see is when the dollar, okay, let me back up here to move forward. Because in 2007, it was, I think it was July 9th. I could be off a little bit by the date, but I remember it was July of 2007 when the US dollar index, which is a product, okay, but when that index broke to all-time new lows against their partners. For me, I'll never forget that day because it scared the crap out of me. And I remember driving home and watching everybody, you know, kind of living their lives and going about, and the sign on the Walgreens building about milk or whatever. And I thought to myself, these people have no idea, but something nasty this way comes. I didn't know what it was, but I knew that that was a really bad indicator. And it proceeded to fall from the lowest level was, I think it was 80.34, and it proceeded to fall down to like 71.32. Okay. Well, what happened when that happened was emerging markets started to issue debt in terms of dollars. Because let's just say it's kind of like that variable rate that we did. Okay.
Yeah.
So if you're going to take out a mortgage, and if you do this variable rate note, it'll cost you $800, where if you do it the traditional way, it'll cost you $1,500. So people not thinking far enough took it out cheaper. And that's exactly what the emerging markets did. The dollar was weak. So in terms of their currency, they made a good deal. Except then the dollar got stronger because we were really in jeopardy of the whole thing imploding at that time. And what happened, China had depegged from the currency. I'm sorry, it's so complicated.
No. I remember this. Yeah, go ahead.
Okay, good. Okay. But China, which was pegged to our currency, had depegged. When we were in jeopardy of breaking below 70, because if we'd have broken below 70, it would have been game over, and there wouldn't have been any way to bail this out. Keep in mind that at that point, we still were the world reserve currency, so the whole globe was dependent upon the dollar. Okay, so China repegged to the dollar when it was in jeopardy of breaking below 70, and then that shot it all the way up. Well, there was a lot of emerging market debt that was taken on, so it's almost like a whack-a-mole kind of thing, right? They wanted to correct this problem because if the dollar had broken through, it'd be below, it would have been much worse.
Okay.
And instead they created this problem over here because, you know, people rushed in, or corporations rushed in to borrow dollar denominated debt. So it kind of bounced around in that area. It dropped down below again, but it's been rising, especially over the last 18 months. The dollar has been getting what they call stronger. Now your purchasing power, on the other hand, for the first time, because people go, well, we have a strong dollar. Has anything gotten cheaper? No. That is because for the very first time, and this just happened in April, the dollar in terms of value, according to the Federal Reserve, has broken below 4 cents.
Yeah. I heard 3.9, yeah.
Yep. So that is really a significant thing. But because the dollar has been getting stronger in relation to the other emerging market nations, okay, they're having trouble paying this debt because they have to use their currencies, which are weaker, to buy dollars. So instead of it costing $1,500 like it would have originally, now you're looking at $2,500, and they can't afford the $2,500. So, I mean, it's a big, we're all in this stew together. It is a really nasty, nasty stew tied together with all of these debt obligations and, more importantly and bigger, those bets, derivative bets against them. And that's really, I mean, we can't overcome the debt issue. That's how money's made in this system, and we're at the end. It can't be paid. But it's those bets. It is those derivative bets. And you've got all of those contracts that have to be amended.
Yeah, but a lot of people are afraid of getting other things amended, their mortgages and their car loans, or their things affecting their retirement accounts, pensions, IRAs, Social Security. People are been subject to so many amendments. They feel like there's nothing they can stand on their solid ground anymore. There's nothing you can count on for the future. We've got
gold and silver.
Yeah. Oh, there you go. Okay. Yep. We've got relatives that ask us all the
water.
time. Yep. There you go. So it's back to real, practical, useful, tangible things, and not all of these counterparty promises and so-called contracts. Contracts should be something that you can count on, and it's not the case when there's always the ability that they can be amended outside your control.
Well, besides that, I mean, other than you, who reads this mortgage document that's fat, or that loan, or the car doc? I mean, it could be a one sheet. This is how much we're loaning you. This is the interest rate. These are the terms. One sheet.
Right.
But then you'd read it.
Yeah.
And you might go, no, I'm not agreeing to that. So you've got to understand the whole system is based upon that subterfuge and making things so complicated and complex that people don't bother to read them.
Absolutely
or if
true.
they do attempt to read them, their eyes glaze over.
Yeah, you can't understand all that. That's very true. We have not moved very often or taken out mortgages very often. So my data points are few, but I will say over the course of the last 35 years or so, every time that we have, the documents get much more complex. I mean, maybe not an order of magnitude, but at least 2 to 4 times as complex and lengthy every time. And the legalese just keeps getting thicker and thicker.
Right.
And by analogy, when people install software on their computer, they're trying to get a job done, so they want to get to the result. And then it says, first you got to sign this license agreement, and you have to read it in its entirety. And you scroll down as fast as you can through 38 pages of stuff nobody can understand, and you click accept and you go on. You have no idea that now you said it's okay to surveil your every move and record your every action and everything.
Exactly.
Hey, before
you didn't even realize it.
No, you don't. And that's the other thing. People have talked about the risk that you do know and the risk that you don't, and their gut is telling them there's a lot more risk and there's a lot more stacked against them than what the giddy, I don't know. And then there's the next generation too. We have 5 children, and they are generally pretty unconcerned, I think, as a lot of the next generation is, about loss of privacy. Why would you want privacy? It's useful. It's helpful to be out there. You put everything you do on Twitter, everything you do on Facebook, everything you do everywhere you go. So what if they're tracking me? That gives me a more enriched, useful experience. I get things that are to my interest or custom to me or whatever. But oh my gosh, the downside of that is that you can't control your own destiny anymore in that environment. Once you give
surveillance, right? Total surveillance society, which China has areas that are total surveillance. And I didn't read this yet, so you might be more aware of this than I am. But I know that China was setting up a system based upon how you use your social media.
Oh, social credits, yeah.
And weren't there something like, I don't know, 1 million people that couldn't fly because they didn't, because of how they were not or were liked or what have you. But Yeah, I mean, they can manipulate you to get you to do what they want you to do through the use of social media. And if you have full surveillance, I mean, that's really what a lot of this technology is about. And the new money system that they want to put in place. That's total surveillance. So they can tax you on a lifetime basis. And so maybe you didn't have such a good year this year, but you had a great year this year. Okay, well, they can go back and claw that back. They can they talk about this. They can take rates negative just like that. They want you to spend and you're not wanting to spend. Okay, you look at your bank account, you got $1,000. You look at it again, you got 900. You look at it again, you got 800, and you haven't spent that money. You going to leave it in there till it goes to zero? No, you're going to go spend it. So the ability
and before you finish that sentence, most people think, well, maybe I'd spend it, or maybe I'd just take my money out and hold on to it. Then I go, well, I'll just hold on to my money. It's like, guys, when there's no cash, you can't hold on to it in that form. You can't leave it in the system. And right. I don't think most people have really connected the dots because we've grown up all our lives, and our parents and our grandparents and forever before, with the idea that if you don't like the way your money's being treated, you can just take it and hold on to it. But in a cashless society, what are your options down to?
You spend it to try and retain your purchasing power.
And if you're going to spend it on something, you better make it something that either has intrinsically growing value or throws off value, like a ranch land or cattle or whatever, or something that's non-perishable, like precious
toilet
metals.
Paper.
Oh yeah, right. Staples. Yeah, that's right.
Yeah, the staples. But even when we say growing in value, it kind of depends on what you're looking at, because people were telling me, but the stock market is so great, right? Really? Because if the value of what it's in is going like this while this is going to here and this goes to zero, which, hey, below 4 cents now, people, below 4 cents, well, 1 trillion times zero is still zero. There are lots of trillionaires in Zimbabwe that can't feed their families. Mm-hmm. So we've got to get past that, just accepting at face value. Though, just the timing of everything. The millennials are the first generation to have grown up and been fully immersed in technology their entire lives. So where the current system, we're working for government debt. I mean, that's what a dollar bill is. Pull it out. You'll see Federal Reserve note. A note is a debt instrument. It is non-interest bearing debt. So where we're willing to work for that now, which is crazy, then the next thing they'll have us working for is a contract that we didn't write, we didn't read, and we sure don't understand. And, forgive me on this one. I've lived so much of my life these days inside of the crypto universe. If it's that complicated to understand, there's a reason why it's that complicated to understand. Gold and silver, they're simple, they're clean. There's a use for them, therefore there's demand for them. In gold's case, they cannot be destroyed, so we can account for all of that. And it takes labor to pull it out of the ground. So I'm working for my labor for somebody else's labor.
And
that's fair.
That's the store of value.
Right. Well, that's why it's a store of value.
Yep.
For those reasons.
And you've just alluded to some of the work that you do there at ITM. Could you give us a quick glimpse at that before we talk to you about your floating islands that you just added?
Sure. Yes, because we are a full-service physical precious metals brokerage house. And while we do definitely specialize, we can do any of the precious metals, but we do specialize specifically in gold and silver. What we really love to do is based on the studies that I've done around currencies since 1987. So we like to put strategies together for individuals that help them address their ability to sustain their current standard of living, and dare I say it, even expand it through this reset, because there's always opportunities. The difference is that most of the time we're not on the right side of those opportunities because we don't understand them. Okay.
And it takes preparation before the crisis occurs.
Yeah, exactly. You're not going to be able to turn this thing on a dime because, frankly, in this next crisis, wherever your wealth is held, that's where it's going to stay. These markets are not liquid. They are not. Okay, so that's really what we specialize in here, is developing those strategies. And, a lot of times when I say that, people think that they can't even think about coming in unless they have at least $1 million or 500 or something like that. No, our minimum's $500 because we really think that, everybody needs to own gold and silver, as well as food, water, and all the other stuff. And these floating islands.
And
awesome.
so now that leads us to floating islands. So you have a avid hobby of being a urban farmer. And we've had so many lovely guests on, such as Joel Salatin talking about how to feed your family on 0 acres and things like that. Now you live in Arizona, so you've got plenty of sunshine, but but water is the question mark, or can be. So you've decided how to solve that. So why don't you quickly give us an idea of what in the world of floating island is? People who've watched the last couple episodes with you might have a clue, but others may have never heard of that. So why don't you give us some understanding of that?
Well, it's actually made out of, it's a pretty neat product, and you'll have some images that you can post, but it's kind of made out of recycled food grade plastic. And then there are like these little holes that are in there, and you put a coconut core. So, the shredded coconut, which is antibacterial, antifungal, and it holds water. Mm-hmm. And then you can put your plants in them. The ones that I got are kind of like a kidney shape, and they're 3x5. So, because I've been converting my entire pool, yes, in Arizona, I have a 12-month growing season, but we are in the middle of drought. So one of the reasons why I bought this house was for this pool that was put in the 40s, and it's somewhere around 55,000 gallons. So it's a nice place to hold water. But I also have, I put in 1, 2, 3 other ponds, and I have a pond in my courtyard as well. And I'm actually growing food for someone in every single pond. But this one in particular is, obviously, it's the largest one. And so I have 12 floating islands. I'm growing food on the part of the islands that are to the edge of the pool. It's easy for me to harvest.
Yeah.
Right? But on the parts that are to the interior of the pool, then I'm just growing water plants. And we only put them in a couple of weeks ago. I don't even think it's been 2 weeks yet, but just barely. And the roots come through the island, and it's part of my filtration system. Yeah. So I have bogs, and then but now I have these floating islands as well as bead filters and UV light, so no chemicals.
Nice.
And the fish are wonderful. I put so far I put in butterfly koi and orphs, which are schooling fish, and I'm supposed to get some, I don't remember what they're called, but they're actually sharks that just eat string algae.
Oh, yeah.
So for the side of the pool, they don't eat people because I'm swimming in that pool. And I'm trying to train the fish how to eat out of my hand and also to swim with me. I don't know if I'm going to be successful, but hey, they do come when they hear that rock.
You're taking recreational urban farming to a whole new level. This is really interesting. We just love it when you give us the updates on this, because every time we talk with you, you've taken the next couple of steps and advanced, farther in learning and accomplishment in this. So we just love to follow along as you've. A lot of our viewers are also doing some gardening or some starting their hand at different types of either aquaponics or different things. So very interesting to hear your updates, Lynette. As always, we enjoy your visits here on Reluctant Preppers. And for people who want to find you on the web, again, the address that they'll find you is?
ITMtrading.com or YouTube ITM Trading. And then also Megan does a great job on all the social media, and that's where she posts a lot of the pictures.
Yeah, that's where I've seen it on your Twitter feed.
And,
yep.
Yep, and Facebook and all of that. And it really is, it's a lot of fun. And it's fascinating. I saw a frog I planted some frogs in the ponds, but I hadn't seen them since I planted them. That doesn't mean I put them in dirt. I planted them in the water.
Yeah.
And yesterday I was out there and I saw a frog on the lily pads.
That had to be
rewarding. So I was very happy about that.
I'm sure the frog was too. Well, we've been speaking with Lynette Zang, the Chief Market Analyst at ITM Trading. Lynette, as always, thank you for joining us here on Reluctant Preppers.
It's my pleasure, and I'll see you next time.
Sounds great. Thanks.